Good afternoon, and thank you for joining us. This is The Future of Institutional Crypto Investments, a webinar from CoinDesk sponsored by Circle. And my name is Mark Hochstein. I'm the executive editor of CoinDesk. And for the next 45 minutes, we're going to be talking about the institutional adoption of crypto, and with a particular focus on the question of yield. And I am delighted to be joined by three CEOs of three of the most important and influential companies in the space. We are joined by Jeremy Allaire, CEO of Circle, Michael Moro, CEO of Genesis Trading, and Mike Belshe, CEO of the custodian BitGo. So gentlemen, thank you so much for joining us today. And I want to kick off, I would just like to note for everyone, there are 980 people who signed up for this webinar. So there's clearly a lot of excitement, a lot of interest in crypto investing in general, in this bull market, and in particular in the topics we're going to be talking about today. And I really want to zoom in on the whole question of yield. So, you know, if you look at the interest rates that are being offered on crypto-backed loans in this market, you know, they really leave in the dust anything that anyone could ever get from a bank. We see high single-digit, double-digit interest rates, just unheard of in this low-rate environment anywhere in traditional finance. So my first question, and I think we'll start with Jeremy, is how are these yields achievable, and how much of this reflects the risk of the borrowers, the counterparty risk, and how much of this is driven by broader market forces?
Yeah, I'm happy to kick that off. I mean, I think there are a few different ways to look at this, and you know, for us, and obviously we work closely with Genesis and BitGo, and in fact, to kind of enable yield products in this market. But you know, for us, I think there are many different types of crypto assets that people are borrowing and lending, and that's happening in a huge range of ways. In the most simple form, right? You have dollars in the form of USDC, and you want to lend those dollars and get a dollar-based return. And so a lot of people look at like stablecoin yields or USDC yields as an interesting proxy. And I think big picture, I think one way to think about this is we now have a capital market infrastructure in the form of digital assets and blockchains where you can very easily take collateral, settle transactions, and face and deal with counterparties in a very, very efficient way, much more efficient than the existing banking system and capital market infrastructure. So it's just like speed of the internet. You have, these digital bearer assets as collateral. It's just like a huge improvement just from the perspective of like collateral and settlement and lending, like just like the operations of this. When you compare it to what you see in traditional lending markets, it's just superior. And those operating efficiencies, I think, have helped this grow because you can operationalize these lending markets significantly, faster and more globally than you can with historical infrastructure. And I think that's part of the bigger story here, which is that over the long run, this public chains, digital asset as collateral and as a settlement infrastructure, and we believe increasing use of things like stablecoins as working capital, not just for trading, but for working capital for payments and use in a business. Those will have this grow to support a very, very broad array of borrowing and lending use cases. Coming back to the heart of your question, which is today, what are the sources of this yield? I think we're in a market where over the past 10 years, and I know, Mark, you got into this industry and started, getting involved in, like a lot of us, 8-9 years ago. over that period of time, this is a market that has produced extraordinary returns that far outstrip the returns of any asset class almost ever, maybe ever. And so the appetite to put capital to work in these markets is fairly high. And the form of capital that people settle in is digital currency. Once you're in these markets and you operate in digital currency, you want to stay in digital currency. It's just a more efficient medium. So the demand for dollars and the demand for stablecoin like dollars is very, very high because people are making really strong returns. And so if they can, what might look like a high cost of capital to some people is actually a very reasonable cost of capital given what's actually happening out in the marketplace. And so at the end of the day, and I would say, Mike probably knows more about this than anyone here. You have a supply and demand. You have demand for digital dollars that is very, very strong. And it's very much indexed today, principally to the amount of market activity that's happening and the growth in these markets that's happening today.
I want to turn to Michael Moro. One thing, coming from a traditional finance perspective, when people price loans for mortgages, for corporate bonds, the usual mechanism was, they talk about spreads. So there'll be some kind of a benchmark, what they call a risk-free rate. It could be LIBOR, rest in peace. It could be the U.S. Treasury rates, but they'll take some sort of interest rate benchmark that is considered, a risk-free rate, and then depending on the risk of the borrower, they charge some spread on top of that. Is there anything like this in crypto? And if is there in terms of some kind of a benchmark to use for determining interest rates? And if not, do you expect that we might see one?
So from a market perspective, no, there is no such thing as exists kind of in the marketplace today. I think the majority of the pricing that exists in kind of the crypto-backed lending market today is purely a supply and demand function where the demand for dollars is extremely high. The supply of dollars within the ecosystem is low relative to the demand, and the clearing price where kind of demand and the supply curves meet happens to be in the 10% area or 15% area, which is obviously much, much higher than what you're kind of seeing in traditional markets. However, though, to your point, Mark, there is, let's say the clearing rate is 10%, just kind of for ease of use. There's a component here from the folks that are lending at 10% that are saying, okay, I'm lending into crypto, right? Into that marketplace. And so they're just by doing that, I'm going to require some like crypto market risk premium, right? And whether that number is 5% or 7% or whatever that is, there is a component in there that is not yet standardized across kind of the capital providers to the space as to what that number is. But let's just say it's 6% today. And then relative to now, it's regardless of who I'm lending to, I'm charging a minimum of 6. And then you kind of layer on kind of the balance sheet and kind of the risk profile and the operations and all the credit spread concept that you're talking about, Mark, on top of the 6, which is why you might lend to 8% at one lender, 9% to another as a differentiator of kind of that counterparty specific risk that you're thinking about. That ability to kind of do that analysis on what the right credit spreads might be doesn't exist yet because one, no one has a public rating, right? Kind of in the public debt market that you might see that somebody's triple B versus double B versus triple C. You can kind of approximate spreads and what that is and kind of add that on to that risk market premium to kind of come up with a rate. And two, everyone, is basically a private company. Your balance sheets are not available publicly. And that kind of the individual lenders to the space. Now, if you do it in size, I'm sure you can get access to certain balance sheets, but the market overall can't, right? And so until there's some more like public disclosures and public companies that are now operating this space, it does kind of get to a difficult point to kind of gauge kind of counterparty basis what that spread might look like.
Gotcha. Mike Belshe, there's a term that gets thrown around quite a bit when we talk about crypto lending called rehypothecation. And it comes up a lot in these conversations. Maybe if you can explain what it is, but also how much of it actually is going on in crypto, and how much of a role does it have in the generous yields that we're seeing?
Sure. So look, rehypothecation is pretty simple. Most of the lending that's happening is collateral backed in the crypto worlds. And rehypothecation is the process where a lender might take your collateral and then use that to lend out to somebody else. And by doing so, they're able to generate larger return. They can reduce the rate that they charge the borrower, a lot of flexibility in how they offer their products. The great thing about blockchains, and where I hope that we get to in the coming years, is that, transparency. There's some that are very concerned about rehypothecation as almost a four-letter word, and certainly it can be abused. So we have seen other markets where this has become a problem out of digital assets, and left unchecked, will the same thing happen in crypto? That's a question that's open. But I don't think it's either good nor bad by itself, so long as everyone knows what they're getting into. Of course, don't forget, all your banks are rehypothecating all the time with your deposits. That might not be a collateral case, but these types of risks exist in pretty much all financial services. So does it happen in crypto? Absolutely. And you can talk to your lender or the folks that are borrowing from you, and make sure that your collateral isn't rehypothecated, and then you can negotiate that, and it just affects, really the return you're going to get, and the same thing is true on the borrowing side. So the most important thing in lending is really having a good program around risk, and Mike hit on this already, but there's counterparties, and they're all different, and there's a risk assessment that can be done. That's the biggest place that you need to look in the lending market. I think today, kind of back to what Jeremy was saying, the reason the yields are so high, yes, there's still professional traders that are coming in that are just building tremendous products that are able to take care of arbitrage. They're able to, offload and bridge between derivatives markets and spot markets and all kinds of things. They're generating huge yields for themselves. And these markets, as Jeremy said, are actually working. They're very efficient. They're great. So there's pretty much an insatiable desire for more capital to come in. And ultimately, that's what's driving the high yield of these products if you're in the lending markets.
I want to ladder one thing off that, which is like, a lot of times there's a lot of expressed concern about exactly what Mike's saying, like, what are firms doing, or from a regulatory perspective, what's the risk and where's the risk? And I just have to underscore again how radically different a market infrastructure is, where the entirety of the assets, the collateral, the transactions, the settlement is all real-time auditable. It's real-time auditable. And so if you want to have a supervisory framework that allows a counterparty, a supplier of capital, a borrower of capital, a supervisor, an auditor, you can in fact provide the necessary information for someone to basically be able to look at that in real time. And that's actually, I think, in the product that we're offering, it's actually really important for people to be able to see on chain. I want to see that collateral, the over collateralized loans. Where is it? What is it? I want to be able to see that and know you're not rehypothecating, and we can't, because that's a regulatory covenant that we have. But I think it's so transformational when you think about the auditability and the observability of financial markets, how opaque they are. The books and records are opaque. Everything's after the fact. Everything is self-reported. It's just so different. And so it's just, this isn't, I think, important just because there's like huge amount of growth in crypto asset values and therefore in the yields that are generated. I think it's really different because this is why a lot of us got into this. This is, we're building a new financial system, and we're building a better financial system that is more resilient, more robust, more secure, more frictionless, and all the other, great stuff that we talk about.
Here's some questions already rolling in from the audience. Please keep those coming. We're here for you. And here's a very relevant one. How big is the market for uncollateralized lending in the crypto space, which would further to our discussion, bring a spread into play for risk considerations. Maybe Michael Moro, you want to start with that?
Sure. To back up, I do think the vast majority of the loans today are collateralized, if not entirely over collateralized, that exists. And so, it's not true credit, right? It's not kind of a credit extension in the way that we typically kind of think about it. It's much more
use
about
a somewhat crude analogy, and I mean nothing untoward by this, but it's not unlike pawnbroking. Is that fair to say?
Yeah, it's probably an easy real world example of how to kind of think about it.
Yeah.
But we probably like to consider it a bit more elegant than
like securities lending is probably.
There you go.
Yeah.
I do think though that the way the space ultimately scales is through like true credit, right? Like advancing 60 cents on a dollar against someone's Bitcoin holdings is fantastic because that gives somebody additional buying power. At the same time, you're not introducing additional capital into the ecosystem in sort of a truly kind of incrementally meaningful type of way. So I do think that undersecured or unsecured lending is sort of an important piece of the equation. However, I think it's one of these things where you kind of have to keep in mind, where the balance sheets and kind of traditional underwriting becomes a lot more important, right? When you have to kind of think about what are the actual risks that you're ultimately kind of underwriting, and how do you ultimately price that risk? So while it's been relatively small in the kind of grand scheme of things, kind of the under collateralized lending market to date, as more and more kind of like traditional institutions kind of enter the space. I mean, we've seen a massive wave of new entrants coming in the last 12 to 18 months or so. They have impressive balance sheets. And so, do you feel comfortable, lending $10 million to somebody with a $10 billion balance sheet? Is certainly not a question that, we were able to kind of think about back in 2018 when we first started lending. But that's one of these things where you kind of do the full credit check on the counterparty, assess the risk and their ability to repay. And certainly in those cases, I do think it makes sense to have unsecured, under collateralized exposure to some of the AAA names kind of within the crypto space.
I would add just a couple thoughts on that, which are, a fundamental thesis that we have is that the sort of both capital efficiency and the kind of settlement efficiency of things like stablecoins will find their way into more and more kind of real world treasury and payments use cases, meaning working capital will be borrowed and used in stablecoins, and commerce and payment activity at a retail level and at a wholesale level will increasingly benefit from that technology. As you move towards that, you get to a world where you actually have the ability to have dramatically more information about counterparties and their funds. And you have this sort of world today in kind of credit underwriting where people will take Plaid and they'll look at your checking account history and they'll say, okay, how much should we loan you as a consumer? Or they'll take various signals like the buy now pay later model and make AI-based decisions to issue credit to you. But if we can provide privacy preserving ways to provide both CeFi and DeFi, providers with access to on-chain data about our capital and our transactions, that could lead to credit provisioning that's far more efficient than the kind of credit provisioning that we have in the existing financial system. And what we think of as unsecured lending, i.e. just normal credit, should be able to function, and the credit markets themselves should be able to operate on chain and be global down to the individual and household and firm level. And I think that that's a really interesting future to work towards. We're not there. We're not even close to that right now. But I think the building blocks are definitely there. And it's something that I'm really excited to see as we see yields and lending go from crypto markets, crypto capital markets to, working capital for businesses. I think all of those things become possible. The yields may look very, very different then in a market like that. But that's, if you think about M2 money, commercial bank, electronic money, M2 money, which is credit provision money, that's $120 trillion. So there's a lot of market to eat into.
I'm gonna want to come back to that thought about on-chain credit in a minute. We have a question about staking that I think Mike Belshe probably would, given your role as a custodian, might be able to help with. I'm stumped personally. Why is staking currently limited to 365 days? Does it have something to do with the mining behind it? And do you see staking long-term as a possible vehicle to save for retirement?
Well, let's see. Right now, staking is very exciting. There's a lot of different chains, a lot of different mechanisms to field that staking. And it looks like a return. By the way, you should actually look at it. Really what's happening is these are inflationary currencies that are distributing the inflation in an unfair way to those that are staking. Now, nonetheless, that means that if you're doing your staking, you're keeping up with inflation. And if you're not doing your staking, you're falling behind. And the more people that are not you that fall behind, that means the more you actually advance because you get those staking rewards instead of someone else. But staking is the role of a custodian for sure. Like, you put your assets into a custodian, the custodian needs to take great care of those, of course, never lose them, but obviously staking should just go hand in hand and those returns should come back to you. So that's what we're working on at BitGo. And then is it a good way to save for retirement? Look, all of these assets that are doing staking today, it's early days. Proof of stake as a technology, it's emerging. I'm a big supporter of all the research in it, but there's a lot of different derivatives of it. So to say staking by itself is a way to save for retirement is not something I can say without actually digging into like which protocols you're talking about, why you think that's a good reason, a good way to save for retirement, et cetera. In general, the asset class, is pretty high volatility, high risk, and staking itself is unproven for the long term with a lot of different branches of staking and the way it's provided inside of these underlying assets. So it's a little bit about staking, hard to answer exactly as it was asked. Oh, on the 365-day question, I'm not quite sure what that's in referral to. Staking is generally a byproduct of participating in the validation or mining of the network. Those operate all year round, this year, next year, and beyond. So I'm not sure what that question was.
Yeah, I don't understand either. Hopefully that answered our audience members' question though. So I want to come back to what Jeremy was saying a minute ago about this future of credit markets operating on chain, because a few months ago I did an article in CoinDesk sort of talking about the potential for uncollateralized lending. And one thing that I was just sort of looking at was when you apply for unsecured credit in the normal traditional world right now, one of the downsides of that, at least if you have a sort of a crypto view of the world, is that you have to share a lot of personal information. You have to share a lot of PII, and you have these credit bureaus that are storing all this very sensitive information that they don't guard. We've seen they don't always guard very well. And anything to minimize the spread of PII, the sharing of PII, all else equal, should be good. And one of the interesting projects out there, Aave, it's the DeFi protocol. They've been have this product called credit delegation that they've had for about a year now. That is sort of a very early form of unsecured lending in DeFi. And the founder has talked about this potential where you could judge potential borrowers' credit by their behavior on chain. And I thought that was a really powerful idea. But I got an interesting pushback on Twitter, where else, on this. And it was a fair point, which is that your on-chain identity can show what you've done with that wallet or that address or that particular ID, but you can have, anyone can have multiple on-chain identities. Whereas, in this credit bureau model that I am not particularly enamored of, that this legacy model we have, from a lender's perspective, a lender can see your entire financial activity, right? Because all the different lenders are reporting to a credit bureau. So whereas on chain, either an entity or an individual can selectively reveal to the world through different addresses, different wallets, their behavior. So the objection to my article, which I hope I'm articulating, was, well, it's all well and good that you don't have to share PII, but a lender needs to see your whole financial picture to make a truly informed credit decision. And that, cross default is a concept in traditional finance for a reason, or universal default, they used to say in credit cards. So I guess I would turn it back to Jeremy, like how again, like as tantalizing as the idea of on-chain identities and on-chain borrowing and on-chain credit is, how much of a limitation is it that we wouldn't be able to see everything that's going on with a borrower's financial situation, given the nature of public blockchains like that?
Yeah, I mean, I think it's a great point, and obviously there are quite a few projects that are leveraging both on-chain and off-chain data as signals to be able to make on-chain unsecured credit decisions or under collateralized credit decisions into DeFi protocols. It's something that we're tracking really closely, but there are also protocols like Maple Finance, which are basically using on-chain infrastructure as a way to make liquidity pools for lending available, to actually have known borrowers, but you're actually going offline to actually do the underwriting, much like Michael's team is doing offline underwriting, right? And so you're sort of in a hybrid world of sort of on-chain transparency and orchestration and execution and some offline other things. Now, I'm a big believer in the progression of this being kind of a hybrid world. I think that there are there is the appeal of a kind of self-contained universe where all of this can happen entirely online, and some of the objections that you raise are interesting ones. But I think in a hybrid model where you're dealing with certainly on-chain data about financial activity, but you're also using real-world identities that have cryptographic proofs that are presented on-chain. But also, I mean, oracles as a model are really powerful, and it depends on how far you want to go, right? There's enough data now being emitted by on-chain dexes that you can now use on-chain dexes as a pricing model, but they actually have underlying dependencies, for example, on oracles for certain other price data. But the ability to have, cryptographically provable data that then can be utilized by smart contracts to make decisions is also attractive. If you have oracles, I know you don't like this, but you have an oracle that's providing credit bureau data, for example, in a privacy preserving manner to a smart contract with a provable identity, then in fact you could have on-chain orchestration of all this, and you're in this kind of hybrid world. And so I think part of this is it's sort of a march towards more and more on-chain treasury activity, more and more on-chain transactional activity, and privacy preserving mechanisms for identity proofs and claims about identities, that some of which may be offline or off-chain and the like. So all of those things, I think, are important building blocks that will get us closer and closer to that.
So I want to ground.
If I could add on that, Mark, I think an important point, which is, you're correct in everything you said, that a creditor wants to know everything about you if they're lending to you in some uncollateralized way. And the traditional system has had that forever. The digital asset system has as well. But now the digital asset system is in an advantaged position, because remember, people can go and take an uncollateralized position in a digital asset market. All you're identified by is your private key. So if that person is taking credit through both decentralized or digital asset systems as well as the centralized systems, the creditors are dependent upon all that reporting coming back, even from what might otherwise only be identified by a private key. As far as I know, I suspect a lot of the lenders from the traditional space are doing that altogether because they figured that out over the years. But right now, what happens if somebody is able to take a loan on digital asset market that isn't exposed to the traditional market, and now the traditional market makes a decision to lend more credit to that same individual without knowing about the digital asset component? So the worlds are blending no matter what, and you can't really stop that.
Grounding the conversation back on a somewhat sensitive topic, but it was brought up by a member of our audience. Speaking of reserves, what do you guys think of Tether USDT? How much inherent risk do you feel we have for second and third order knock-on effects on the broader crypto and stablecoin markets? Should their commercial paper underperform? So, Michael, actually, you know what? I'll phrase it slightly differently. We've learned a lot about the dominant stablecoin, or at least more than we used to know in terms of the backing. And we know that close to 50% is commercial paper of the reserves. We don't know who the issuers are. We know that a portion of their reserves is even in other digital assets. But that asset has very consistently traded at or near $1 for most of recent memory. There was a little bit of a scare a couple of years ago, but even with all the stuff that's come out in the last year or so, it just feels like traders don't care. So, Michael Moro, maybe explain this phenomenon.
Yeah, so it's funny. I think coming from kind of the traditional finance world and kind of looking at the whole question around the USDT and what's backing it and all of that stuff, it would definitely have an impact on the price of kind of the asset, right? And I think on that question, we've seen quite a bit of Genesis clients taking short positions on Tether, either like previously or recently, as a hedge against some sort of black swan type event that the market and a risk that the market itself is not pricing in, because the Tether itself is still continuing to trade at $1. And because it doesn't really trade at a premium to the dollar very much, there isn't kind of that short squeeze scenario where you lose much kind of above the dollar. And so it seems like a one-way trade for a lot of kind of the institutional investors, as long as they're able to kind of pay the interest expense on the borrow, right? And on the other side, though, when I've spent some time over in Asia, and a few years ago, if you remember, the New York AG had come out with kind of analysis, and they said, somehow Tether only had like 65 cents on a dollar or whatever, kind of like backing each Tether token. And like it traded like you would think that, okay, the asset would trade at 65 cents, and then it didn't, right? It actually rallied to a premium based on that news. I went over to China. I kind of asked about it a few years ago, and they're like, it doesn't matter. If we think Tether is worth $1, then it's worth $1. Money is a belief system, and I believe that Tether itself is worth $1. Now, at some point, does that logic break down if the report had only said 10 cents on a dollar or 20 cents on a dollar rather than 65 cents on a dollar? Logic would dictate, yes, it should, but to them, it didn't. Ultimately, it doesn't matter because they are firmly of the view, and there's enough utility in Tether being worth $1. And so the market has been telling you for a very long time that it's worth $1. People have tried to kind of trade off of it and haven't been successful, but it is still an opportunity for a lot of institutional investors today that still, if it's worth $1, and it shouldn't be in their minds, then that is a trade opportunity and a risk that is currently not being priced correctly. I would add,
and I have strong views on these topics, as you might expect, but I would just say at a high level, I think to ladder off something Mike shared is, for the things that I think to a traditional finance person are really problematic about Tether. It's opaque, it's offshore, it's unregulated, it's got a basket of risk that no one really understands. Those are features, not bugs, to a lot of people in China. The idea of a shadow banking model where they can control it entirely without the government being able to take their private keys, the ability to have something that's out of the reach of the Chinese government, that's out of the reach of the American government, that is an offshore shadow banking dollar, that's extraordinarily appealing to Chinese. And so the things, so it is a belief system. It's like, we need this to be our shadow banking dollar, because that has a very high utility value for us. And so I think part of it is Asian traders are basically saying, hey, we're betting on an institution that's going to say F you to China and the US and is going to run this thing this way. And that's a feature. That's a feature. And now, is that a feature that is going to undergird the global financial system, or is going to be used broadly in capital market functions, or that's going to be used for mainstream scale retail payments? No, it's not. But in a large section of crypto capital markets and offshore crypto banking, I think it actually does play a significant role, and it is well supported by those that feel that that's important.
And it's still the number one stablecoin.
I would note that USDC has grown to nearly half the size, and is growing its market share very, very fast relative to others.
While we're on the subject of transparency, I mean, this is, we've also seen a lot more transparency from over time from USDC. First the reserves, and then now that you're soon to go public, we see the balance sheet. Should stablecoin issuers be subject to the same disclosure requirements as, say, money market funds?
Well, so a couple things. The first, and this is like often misunderstood, dollar stablecoins that are issued in the United States by regulated financial institutions are issued under banking supervision today, and they always have been. They're supervised by state banking supervisors. They're examined, they're audited, and there are legal requirements on the balance sheet. There are legal requirements on the reserves. There's consumer protection frameworks, insolvency frameworks. All this is in place and has been in place for over 3 years for all of the dollar stablecoins issued by regulated financial institutions in the United States. It's sort of like people kind of completely miss that fact, that there's somehow this thing that's happening that somehow just it's willy-nilly whatever these issuers want to do. No, state trust bank law and money transmission law provides a very clear framework. It's the same framework that's applied to the $35 to $40 billion held in PayPal balances, the maybe 10 billion in Square Cash App balances, and on, that no one is asking Dan Schulman, tell me about your reserves for PayPal balances. They don't need to, because guess what? There's bank examiners and auditors and laws that are saying there's a permissible set of things that you can do that have a liquidity mandate that the banking regulators have deemed to meet the redemption requirements of an electronic money stored value instrument. So that's in place and has been in place, and it's always been in place. And those are the protections that exist today. So no, I don't think that this should be money market funds. I think this is exactly what it is, which is it is a payment system innovation that's emerged out of the fintech laboratories of the US state banking regulators. Now, should it be upgraded to something else, as recommended by the Federal Reserve and the US Treasury Department this week? We do believe it should be upgraded, because these are becoming really large, handling trillions in transactions, potentially hundreds of billions, if not trillions of value stored in them. And it's not just like a peer-to-peer payment app. It's actually financial market infrastructure that people are building on, and capital market infrastructure people building on, and other financial institutions building on it. Then it likely ought to be supervised under the Fed and banking law. and have a very specific sort of reserve and liquidity covenants attached to it that may be bespoke to this industry. So we concur with that view, basically, and devil's in the details, obviously. But I think it's important that people understand the real world grounding of this today, at least in the United States. And so the United States is actually quite advanced in having regulatory frameworks around this.
We had a question about DeFi that I want to make sure that we address. We're almost at 45 minutes, but we're going to keep going until 5 because we've just got so many great questions and so much more to talk about. So do you guys think the high yields that we see in DeFi are going to continue, and for how long? I don't know if Mike Belshe.
Let me take that.
Yeah.
Sure. Look, I think they're going to keep for a while. The market is early. There's certainly a lot of I would say low grade quality things out there. But the industry is evolving. It's innovating. It's innovating in rates that, frankly, we may have never seen before in any software industry. A combination of globalism and finally hitting a financial services sector that hasn't been invaded by software yet. So I think we're going to continue to see it for a while. It takes a lot of attention to detail to manage those, but there's better and better tools. Because it's all automated, you're going to see a few people really come out as big winners because they've got a level of transparency. It's all unchanged 24/7. They can do flash loans. There's going to be a lot of really clever things that happen. We're also going to see the downside of this new technology. We've seen a number of failures in smart contracts that have been deployed that are intended to generate yield. And when the principal disappears, it eats up all of that yield for many past years of goodness. So, there's still a lot of evolution that's happening. I think this is all a natural process that happens with software. In the long run, it probably levels out as things really become commoditized, but that's going to take decades.
Michael Moro, how is this would apply to both DeFi and just crypto lending that goes through companies. How reliant are these yields on the fact that we're in a bull market? And what's the risk that these robust yields that we see would 12% so would drop to 1% or something like that in a bear market?
On the crypto side, we should differentiate like crypto lending versus kind of like the dollar, like the crypto backed lending of dollars.
Yes.
The crypto lending market, because there isn't a lot else to do with your Bitcoin, other than like buy, sell it, or hold it, lend it is kind of one opportunity. So I think there's a lot of crypto out there. The rates on crypto, Bitcoin is already kind of in the 1% to 3% area. So it's already kind of in that market. The dollar side of the equation, I cannot possibly see or foresee in the next 10 years getting to 1%. Part of that is kind of that crypto market risk premium that I mentioned at the head of the call. Unless somehow the crypto market becomes just like lending to the kind of the equities market or the FX market, I don't really see kind of the rates ultimately kind of coming down to that level. Number two, you can enter a bear market, but like the biggest function for me as to whether or not the price, the rate or I guess the money, the price of money coming down to even that is kind of the big banks, the traditional lenders starting to provide like tremendous amounts of capital to the space. While we've seen some banks start to make loans into the space, we're in conversations with lots of kind of the biggest banks in the world about trying to do something similar. It is going to take quite a long time for it. And frankly, the reason they're looking at it is because they can earn the high yields. If the yields were only 1% or 2%, they wouldn't be bothered looking at this asset class from a returns perspective, right? Because the risk reward wouldn't be there for some of the biggest banks in the world. And so the rate being high is going to be a prerequisite for the supply to kind of come in. Then once the supply is in, it's possible that certainly over time, rates certainly come down. I do think rates will come down over time. But a bear market isn't necessarily going to plummet the interest rate in the dollar market.
I would just add one thing on that, which is, it ties into some of the things that were discussed earlier, which is, commercial bank lending. If you take that, we're talking about, mostly here kind of capital markets lending, but commercial bank lending. If digital currency moves to be operational in the real economy more and more, as we expect it will, then you should look at what are the rates that you see in commercial bank lending. These are 4, 5, 6, 7, 8, 9% rates paid by borrowers, 17%, 20% paid by borrowers, where you are in terms of households versus firms, and net interest margins for banks at like 300 basis points. And so it's not like that's the at scale lending economy that exists today. And it's not like that's down at 1%, right? And so I think if you take traditional lending and you say, hey, we can do it here, you might be able to make the margin better, because you can do it more operationally efficient as well.
So another question from the audience. How do you see the regulated derivatives market evolving in the US for 2022? You want to, Michael Moro, start with that?
Sure, I'll start and I'll turn it over to Mike here. The regulated derivatives market, I think, is only going to kind of continue to grow. Obviously, the CME is going to, I think, launch the Ethereum mini contracts shortly. I would fully expect them to kind of add on additional products in 2022. On top of that, the CBOE is going to be re-involved again, kind of in the crypto market, after they were the first ones to kind of get involved in 2017. They didn't catch was successful as kind of the CME product, and so they're now investing in RSX and kind of revitalizing kind of their crypto efforts that way. We had FTX kind of purchase LedgerX just a few weeks ago to kind of launch a US regulated derivatives market. And so I think we'll see a lot more regulated venues in the US continue to pop up, and as well as kind of create a whole number of different products within the space, which is all, again, all access products for, the institutional investors that can't touch crypto, but I'll be allowed to kind of get, at least kind of dollar exposure to the asset class, which is, again, a fantastic thing.
Mike Belshe?
Yeah, for the last few years, we've all been excited about the ever increasing institutional adoption, and it is happening. But I actually think that, the largest traditional firms are mostly going to miss the boat on digital assets. And for that reason, it's going to, we're going to see actually really strong derivatives markets, ETFs, et cetera. What's happening right now for the biggest guys is they're really struggling. They've got an innovator's dilemma of sorts, which is that they just can't quite understand this market and get direct exposure into it. So they're going to look for every arm's length approach that they can take. The derivative market is fantastic. It fits within their existing tooling. They know how to sell it to their clients. They know how to use it. It needs to be bigger, obviously, as we've seen just this last week with the launch of the first futures ETF. But as the spot ETF comes online, which hopefully will be in the not too distant future as well, I think we're going to see a lot of traditional finance participate on those parts of the market, and they're going to be happy there. Their systems work, their teams can do their stuff, their sales teams are off, selling the exposure that they've been talking about. They could say that they're in on crypto. Really what they're getting at is the price exposure. But digital assets, crypto are going to continue to innovate and change, and they're going to really struggle. The DeFi products are going to emerge. New ways of using the asset class are going to emerge, and it's going to require that you either be in it or you're not in it. And so other than providing, access to price exposure, they're going to miss out on the rest. Nonetheless, big DeFi markets.
That segues really interestingly to this question that just rolled in. What are the next steps the big banks are going to take to keep their customers from moving their capital to DeFi? We've seen total value locked go from 20 million to now 100 billion in 2 years' time. Are the banks starting to take notice?
So I'll just continue on that. Look, they're taking notice for sure. They're struggling still with Bitcoin. So we're not talking DeFi yet.
Right.
They're still like kind of the basics. And I know every bank on the planet has a proof of concept as a team. They're working on it. They're working on it hard. They're sincerely working on it. But that's a big difference from actually launching and taking the risk that it's going to work with your regulator. And I'm not sure very many of them are actually going to really do that in size. I think most of them are going to miss. So when you start talking about DeFi, now you throw in a whole new set of monkey wrenches, which is that you don't know who the other parties are. And often, the exposure on the security side is weak. The decentralized nature of where we're doing smart contracts is not the same as what we're doing in the Bitcoin world. Anyway, DeFi, they'd love to participate. They have no idea how to participate. It's going to be a while.
That I think takes us back to the comment that Jeremy made earlier about this sort of hybrid system emerging. If again with Aave, there was some controversy with Aave, with their Aave Arc, which sort of had a permission component to it, and this was seen as heretical within the crypto community, within the DeFi community, but it just appears to be a prerequisite for institutional participation.
Yeah, I have a lot to say about this. I mean, my view is, the benefit, if you're an institution, the ability to face counterparties directly for liquidity in a market that's directly on the internet with instant settlement, with the ability to kind of face off with collateral in very, very efficient ways is extraordinary. And the market structures that are being built in decentralized finance are really innovative. And so I think there is a strong desire amongst institutions to be able to interface with market structures that exist on chain. I think, and therefore, I think that the amount of institutional capital would be there, but you need mechanisms to have cryptographic proof of counterparties and identities. And you need to be able to have that work in a way which can interface with a smart contract or a set of smart contract protocols. And so I think we're seeing really interesting work happening in that space. I don't think the whitelisting of pools is necessarily a scalable model. I think there needs to be models where there are kind of credible identity issuers that are financial institutions, where you have credentials that can be utilized in custodial, non-custodial, software, hardware, other models that then can present themselves to these types of wallets and smart contracts and allow for safe interaction with that liquidity. So I think that's a big building block. I think that's a big theme we'll see in 2022, is that build out of that kind of infrastructure. And I think you'll see protocols that basically say, no, we're gonna remain entirely pseudonymous, so to speak. And I think you're gonna see more and more protocols that have options for facing credentialed counterparties, but we're in very, very strong privacy preserving manners, and you're going to see hybrids, and that'll really be a test for further institutional participation in decentralized market structures.
I want to get back to a comment Mike Belshe made a couple minutes ago about how these traditional players, some of them are still just trying to wrap their heads around Bitcoin. When you talk to institutions about Bitcoin, what's the thesis that's getting them interested? Are they thinking of it in terms of this inflation hedge as digital gold? Is that the narrative, or is it just that they're looking for alpha wherever they can find it in this this low rate environment?
I think they're responding to their clients is the primary driver. Inside of the large institutions, you're always going to find three groups of people. You're going to find a few people that are really, they get it. They might think it's an inflation hedge. They might see it as a number of other beneficial components towards the future of finance. But you're going to find a lot of people that are really concerned about it in that same organization. And then you're going to find a lot of undecided people. And the people that have a conviction, either pro or con, are going to fight, and they fight for a long time. And so what wins the fight is when your clients are screaming, I need my access to the new future of finance. And that's what's happening. Every time we see one of these rallies, they get a lot of calls from their clients. And so it kind of ends the internal debate, and instead it becomes, what does the customer need and how do we service that demand? They're desperately afraid of having a competitor show up and say, we get it, Bitcoin, we love Bitcoin, we're going to adopt it. And so they'll put out those messages to make sure that they don't lose any clients. But yeah, so if you're into Bitcoin, you should continue to push and ask every single one of the financial institutions you interface with. If you support Bitcoin, just keep asking.
In a similar vein, Mark, there's a lot of banks that I've spoken to that are like, we really, really, really want to be the first to be second. Right. Like, and it's a common theme kind of across a whole bunch of different banks. And so, none of them, for lots of different reasons, I'm sure, kind of regulatory not being the least of their concerns as to why they wouldn't want to be the pioneer here. But they know, to Mike's point, that they don't want to be left behind. And so they describe themselves as very, very fast followers. But somebody has to kind of break through, right? Somebody has to kind of ultimately be the first one to kind of make it work, and we'll see what happens.
We are almost out of time. So to wrap it up, this is coming out of left field. I'm going to ask each panelist to make a fearless prediction for 2022. Let's start with Mike Belshe.
We'll see a Fortune 500 company with its own token.
Wow. Michael Moro, fearless prediction for 2022.
Oh boy. I would expect 5 additional countries around the world to pull the El Salvador.
Wow, 5. What do you think is going to drive that?
I think, certainly the questions about moving away from a US dollar reserve, I think, is kind of resonating with a lot of different countries around the world. And frankly, I do think that, the El Salvador has kind of garnered quite a bit of goodwill from certainly kind of the crypto community, and certainly having, the buy the dip mentality and having profits to kind of show for the risks that they've taken. And they recently announced that they're going to build, 20 additional schools within the country with the profits that they made off of Bitcoin. All of that kind of stuff, I think, is a narrative that can easily fit into a number of different countries around the world.
So look for a lot more laser eyes on heads of state here ahead. And last but definitely not least, Jeremy Allaire of Circle, fearless prediction for 2022.
Sure. So can I make 2?
Please.
All right. So I actually want to concur a little bit with the last one, which is to say, I think multiple, kind of group of 30 countries will hold Bitcoin on their central bank balance sheets. So I don't think it's just going to be the El Salvador's. I actually think we'll see experiments with holding Bitcoin in larger countries. That may not be a legal tender, but I think as a reserve currency asset, because I think Bitcoin will actually exceed the pound and the yen as in value, and so I think you'll see more of that. The other is, I think you'll see some of the biggest retailers in the world accept stablecoins as a payment option in 2022, and so we'll start to see that bridging from into more mainstream payments as a result of that.
Well, we'll have to come back in a year's time and see how all these predictions played out. But this has been a fantastic conversation. I want to thank Mike Belshe of BitGo, Michael Moro of Genesis Trading, and Jeremy Allaire, CEO of Circle, for really sharing a lot of insights. Wish we could continue, but I'm afraid we're out of time. Thank you for everyone for tuning in. Thank you for the great questions, really smart questions, and have a great afternoon. Take it easy.
Thanks, everybody. Bye-bye.
Thank you so much.
All right. We're out. Okay. Okay.